Trend. You've probably already heard of a trend. On your chart, it simply looks like, when a stock is in a downtrend, we want to be a seller. One important thing to note is that you don't want to buy stocks in a downtrend and sell stocks in an uptrend. This is not investing where you're going to hold on for years as you are trading and exit the markets in and out depending on your time frame. One thing to share with you that to define a trend, you can use the 200 period moving average. You can see that the price of Amazon right now is above the 200 MA. So when you see prices above the 200 MA, it systematically gives you a bias that you want to be buying only in this market because the market is in an uptrend. Vice versa for downtrends. If the price is below the 200 MA, you either want to be selling or holding on to cash. Of course, there are exceptions, especially traders who are more advanced in their trading methodologies. But if you are still new to trading, then this rule will keep you on the side of the markets more often than not. This is foolproof, but it will keep you on the right side of the markets more often than not. Next, area of value. Just because the 200 MA tells you whether the stock is moving higher or lower doesn't mean you buy immediately. Just because you see oranges in a supermarket that's selling right now, you don't buy the oranges immediately. Why? Because maybe the oranges are overpriced because it's not the right season, or because you can buy even more oranges during a sale. So you want to wait when the price is at an area of value for your oranges, and this is the same for trading. You want the price of the stock to come to an area of value before you consider buying. How do you define what the area of value in trading is? These are a few techniques that you can use. Support and resistance, trend line, moving average. There are more, but I find that these three are pretty easy to understand and use. So let me explain. Support and resistance. You can think of support levels like a floor. Support is where the price has difficulty breaking lower. I want you to think of this floor as a wooden floor. It can provide some support to push the price higher, but it's made of wood. Wood can also break. So don't think just because the price is coming to an area of support, it will definitely bounce. Also, you can see that support is an area and not a fine line on your chart. The second thing that I want to share is the trend line. Trend line. The trend line is like support and resistance, but the difference is that this is a diagonal trend line support. You know that there are many types of moving averages out there. Like for example the 200 period moving average, and how it can help you define the long-term trend. However, you know that's not the only moving average you can use. You can use the 20, 50, or 100 moving averages as well. It could have different purposes, just like the 50 MA, which acts as dynamic support. I find that candlestick patterns are very useful for this purpose. You can use reversal candlestick patterns like shooting star, hammer, bullish, engulfing bearish. Engulfing. If you don't understand, I'm just going to run you through quickly on candlestick how to read a candlestick. As you can see, there are two types of candles. It's green and red. If the candle is green, the price opens lower and the price closes